All right, welcome everybody. Sean and Derek from RPH Ally. We are talking about the Silicon Valley Bank failure right now. So, anyways, a quick shout out to PharmD Podcast Network, and then obviously Derek Delaney from PharmD Financial Planning for kicking this off. So, but first, let's go to our reel. All right, Derek, thank you for this topic today. Derek texted me on Friday, Saturday, something like said, hey, let's do this for a topic instead. And I was like, that's actually a great idea because, Derek, you've also talked about, a potential recession coming up like in 08. And so that's scary. Then all of a sudden you see this big bank failure, where people may, be scared of like the snowball effect, or they're going to stop depositing money. And anyway, so hopefully you can shed some light on that and put maybe our hearts at ease a little bit on this one. So I'm going to give you the floor, Derek. It's all you, my man.
Yeah. So if anybody out there has been paying attention to the news at all, the biggest headline since Friday is the basically closure and insolvency of one of the biggest banks in America. And a lot of people will look at that and they will have nightmares remembering what happened in 2008 with all the banking closures and all the problems that happened with that great economic calamity, right? So when a lot of people go, well, is it happening all over again? Should I be prepared? In my opinion, as of now, and new information is always coming out, is that we're not going to experience 2008 again. And this is a unique circumstance, specifically with Silicon Valley Bank. And if you'd like, Sean, I can walk through how it all happened and why things played out the way it did.
Please do. Please do.
So Silicon Valley Bank was the 16th largest bank in America. So it was a huge financial institution, and it primarily focused on serving startups and entrepreneurs in the tech space. And before we can understand what happened last week, Friday, we have to go back 3 years. And 3 years ago, we were just starting with COVID and the lockdowns and everything else, right? And I don't know if you remember or not, Sean, but in 2020 and 2021, technology companies were extremely prosperous. I mean, the stock price of a lot of these tech companies like Zoom were just flying off the charts, right? And because of that, it incentivized a lot of new business to start up. And when new tech businesses start, they look for venture capital. They need to raise funds in order to grow, right? And because of all of the great success these tech companies were having during COVID, a lot of venture capitalists were shoving money into the space. And if you were in venture capital funding, you placed it. And the obvious place to deposit that money was in a bank. And because Silicon Valley Bank, especially in working with a lot of this money ended up at Silicon Valley Bank, which made 2020 and 2021 extremely prosperous for that financial institution. But with all these deposits, the bank needed to do something with that money because they just can't sit on it. Banks make money when they're able to do stuff with customer deposits, and they collect the net interest margin on whatever they do. So a lot of banks end up loaning money. What Silicon Valley did is they went out and they made a prudent and smart move, and they invested a lot of the excess capital they had through those additional deposits into mortgage-backed securities and government treasury bonds, because they are stable bonds that should have been relied upon and could have been relied upon to pay out consistent dividends and to keep the whole machine working. Well, when 2022 happened, a lot of that venture capital money stopped flowing, which means a lot of those new startup companies and a lot of the tech companies had to start spending more of the original money they had on deposit, which is called burn rate, right? For a lot of tech companies, that's the lingo they use. And all of a sudden, all these deposits that Silicon Valley Bank had on their books started to drop significantly because a lot of these tech companies were continuing to spend without the windfall and new venture capital money coming in. So Silicon Valley Bank had to make a prudent move, or I think it was a prudent move, in selling some of those mortgage-backed securities and government treasury bonds in order to raise capital to allow themselves to have enough cash on hand to give out to depositors who came to withdraw. However, because of interest rates skyrocketing in 2022, bond investment vehicles drop in value as interest rates go up. So as interest rates went screaming up in 2022, a lot of these mortgage-backed security bonds and government bonds dropped in value, which means when Silicon Valley Bank went to sell some of those investments, they realized significant losses on those investments, where I think it was almost $2 billion. That $2 billion loss sent shockwaves to a lot of venture capitalists and other people who had financial interests in the bank, whether through deposits or investment. And all of a sudden, headlines started sprouting up all over the place that Silicon Valley Bank might not be doing very well because they experienced this $2 billion loss. And as those headlines grew, it instilled a lot of panic for Silicon Valley Bank depositors. And it capitulated on Thursday last week into Friday, when over a 24-hour period, almost $42 billion of deposits were withdrawn out of the bank. When they realized those losses in the beginning and then had all that deposit come out within a short period of time, assets and liabilities then overtook assets, which means the bank in a short period of time, just like that, became insolvent. And we now know that the government has come in and they are now backing 100% of deposits for those people who would have been out of luck, in order for a lot of those entrepreneurs, startup companies, and everybody else who had deposits that would have been gone to be able to continue with their operations, to make payroll, to live on that money or whatever else they deposited the money originally to begin with. So fascinating situation that happened in a blink of an eye. And it just shows how fast bubbles can pop when certain economic conditions are right.
Wow. So just for my understanding, that's fascinating. Thank you for walking us through that, Derek. With Silicon Valley Bank,
Yes.
I mean, they're still there operating because now they're backed by the U.S. Is that so? Anybody continuing to use Silicon Valley Bank, they're okay? Or is this once everybody gets their money, they're going to be basically done, that bank?
So this is really interesting. So on Friday, when they locked up and they ended the workday, the FDIC comes in, government employees, and they take over the bank. And that's exactly what happened. So it's not Silicon Valley Bank anymore. It's actually Federal Depositors Bank or something like that, because the FDIC now controls it. They're going to continue to pay Silicon Valley Bank employees to stay on. I think they're going to pay them like 1.5 times what they were making before, just to wrap up operations within the bank as they prepare for it to eventually cease to exist or get bought out. So Silicon Valley Bank is no more. The FDIC has taken it over, but they will run it as if it were still standing and still running.
Okay. Yeah, I was worried. I mean, and I have no idea. I've never gotten into that conversation with our tech partners and, that we're partnering our PHL with. And it's like, I was like, hopefully they're not in that bank, right? Fascinating. Okay, good. So don't have to be that scared.
No, I wouldn't. So a lot of people, again, they go, well, it's 2008 all over again. I don't think so, because Silicon Valley Bank does not have the reach or the systemic risk in other areas of the economy and with other large financial institutions that was similar or present in 2008 with mortgage-backed securities. So I don't think we're going to experience what we experienced in 2008. And I think the government coming in and guaranteeing all deposits, irregardless of the FDIC $250,000 limit, I think that's brought panic down a little bit, which is good. But anytime government steps in, there's always going to be unintended consequences as far as outcomes, and we don't know what those are going to be yet. So it's going to be a fascinating situation to watch. And like I said before, this is just the tip of the iceberg.
Yeah, no, you're right. I'm glad you said that. Whenever the government comes in, right? How about lessons learned? Like, what can we do if we're business owners looking at this? Like, anything that you can provide there for our entrepreneurs within our PHL and the pharmacy profession that want to scale still?
Yep. So I think if you scale and you create a big business where you have millions of dollars on deposit, you need to do due diligence on where that money sits. Where before, 24 hours ago, the FDIC insurance limit was $250,000. Now it seems like it's infinite because the government's come in and said they're going to back it all. And I don't know how they can walk that back from future situations. But doing due diligence on the financial institution that you're depositing your money into is important. Just like doing due diligence on a company you're going to invest in through their stock. The other thing is, and I said this before, I think this is a perfect example for people to show how fast bubbles can pop and what the unintended consequences are after that happens. And the speed of that happening is is a lot quicker than most people expect or realize. So look at all the other areas in our economy that were inflated or that were built up due to all the money being injected into our economy because of COVID in 2020, 2021. There could be other similar pockets of our economy that might experience the same thing that Silicon Bank just experienced in a completely different sector. We don't know. So it's always good to keep your eyes open for different things like that. And if things seem too good to be true, there's probably going to be a consequence to pay at some point in the future because of it.
It's awesome advice. Awesome advice. That's it for me, Derek. I don't have anything else for you, but that was fascinating kind of presentation there. Thank you for breaking that down. Any final parting thoughts on wisdom that you can drop for these folks?
Don't panic. Don't be the person that shows up at a bank and requests to take $250,000 of cash out. Chances are your institution doesn't have money on hand to be able to do that, especially if you bank at a smaller regional or community bank. So don't panic. Don't do anything irrational. The other thing I'm going to point out too is you can actually have more money than $250,000 at a financial institution and have it all covered under FDIC insurance if you have the accounts and titling of those accounts set up in specific ways. So if you have more than $250,000 and you're a little bit worried being over that insurance limit, even though it might change to be infinite, talk to a banker and figure out how you can make sure all of it is insured without pulling deposits from those institutions. And you're going to hear a lot of, I think, negative news and a lot of new information coming in over the next couple of days. I would just be very, very cautious in buying into any sort of hype, and just don't make any knee-jerk decisions based off of hearsay you hear online or through any media outlets, because they always seem to make it worse than it actually is.
100%. No, that's very true with the media. So that's great wisdom and thoughts there, Derek. Love it. Thank you so much for your time. Thank you so much for taking care of us. We'll be talking soon.
Glad to help. Thank you, Sean.
All right. Take care.